My name is Stephen Reiter. I'm part of the AvaTrade group. I'm responsible for the options trading product, which means I'm responsible for a lot of the content that you see on the AvaOptions websites. I'm running webinars, and I've designed the options program for AvaTrade. So without further ado, let's get into this presentation. It'll get smoother as we get along. What is an option? What is a currency option, and what is an option? An option is very simple. An option is simply a contract between a buyer and a seller, where the buyer has the right, but not the obligation, to buy something in the future at a known price in a known amount. It is simply a contract between two parties. Okay, so that is an option, the right, but not the obligation. And that's what differentiates it from the trading that you're typically doing in other platforms like MetaTrader 4 or MetaTrader 5, because in those platforms you simply buy or sell. Here you have the right to buy, but not the obligation. If you have the right to buy, that's called a call option. You have the right to sell is called a put option. The right to call something away from your counterparty, okay, is the right to buy at a known price in the future. And the right to sell, the put, is the right to put it back to your counterparty. How does it different from foreign exchange or just trading any asset? And the difference there is, as I said, with foreign exchange or with CFDs and with other things you might trade, you have the obligation to buy or sell. When you have the obligation to buy or sell, that means that the market goes up, you can have unlimited profits if you buy. If the market goes down and you've bought, you can have unlimited losses until, of course, you hit a stop loss or until you hit a margin call. Let's put it into a picture. Put on my little laser pointer. No, I'm going to put on my pen. This is a picture of trading Eurodollar, just buying the Eurodollar. On the x-axis along the bottom, we have the rate. As the market goes higher, oops, I don't want the laser pointer. I'm sorry, I want the pen. Let's get the highlighter. That'll work. As the market goes up, why isn't that working? I'm on the wrong place. Sorry. Let's try pen, and the color is red. Here we go. If you buy and the market goes up, you can have unlimited profits as the market goes higher. However, if the market goes down, you can have unlimited losses until you hit either your stop loss or a take profit. And I'm assuming here that everyone on the call has some experience with trading. That's trading foreign exchange or trading any CFD. If you buy, you have unlimited profit potential, and you also have unlimited loss potential. Here's a picture of an option. Here we're looking at a call option. I'm going to compare that to trading the underlying asset from the previous page. I've written the word forward because when you trade an option, you're trading it for a day, a week, a month. You have the right to buy or sell for some known period of time. Okay? So here's the major difference. With an option, you have the right to buy, but not the obligation. Therefore, if the market is going up, you have the right to buy at a known price. You can buy at that known price if it suits you, and if it doesn't suit you, you don't. This means that as the market goes down, you have limited losses. You cannot lose more than what you paid for the right to buy that asset. Okay? So your maximum loss is what you paid for the option. Your maximum upside is unlimited. It's only less than the forward, or only less than trading the underlying asset by the amount of the premium that you paid. Let's look at a page with an example. This is a picture of buying a 1-week call option on Eurodollar with the strike at 115. Okay, 1.15. The strike of 115, the strike is the price at which you have the right to buy the asset. So we have the right to buy Eurodollar at 115. The expiration date is 1 week. It's a 1-week option. Think of it like insurance. You buy insurance in your car for a week, for a month, for a day, okay? A year, same thing here. This is an option for 1 week. It's going to cost me 0.006, that's 60 pips. And that's looking at pricing, using the pricing today. I pay 60 pips. I have the right to buy euro-dollar at 115. If the market goes to 117, that's great. The market goes to 117. I have the right to buy at 115. I'm going to exercise that option, right? If I have the right to buy at 117, at 115, when the market's at 117, I've got 200 pips of profit there. So I'm going to exercise the right to buy at 115. I'm going to sell it back to the market at 117. What's my profit? It's 200 pips, or 2 points, minus what I paid for the option, which was 0.006. So my profit is going to be 140 pips. What's my maximum loss? As we said, the most you can lose is what you paid for the option. 1 week from now, if the market is lower, if the market drops to 113, 112, 111, you walk away. You have no obligation to exercise that option. So this is the beauty of options trading. You can create asymmetric risk. You have the right but not the obligation to buy that asset with a call option. All right. We're going to open it up to questions a little bit later. Let me just continue since we got a bit of a late start. Definitions. We already said we've got a call option, which gives you the right to buy, and a put option, which gives you the right to sell. The cost of the option is called the premium, which you're familiar with possibly from insurance. The strike, we said, is the price at which you have the right to buy. That's where you can pounce and strike and buy the asset in the market or sell in the market to your counterparty. And the expiration date is the date and time on which the right can be exercised. And in our business, in our platform, and in the foreign exchange market in general, customers are trading European style options, which means that you can exercise the option only on the day of expiration. So if you buy a 1 week option and the market goes your way after 2 days, you don't exercise the option right away. You sell it back to the market, or you sell it to your counterparty, because it still has value. It still has time value. You'll learn about more in a moment. Here's a diagram of a put option. A put option is just like a call option, but the other way. We have the right to sell at a known price. So we're going to compare that to selling the asset itself. So going short euro-dollar or going short a euro-dollar forward. When you go short the market, it's because you believe the market will go down. If the market goes down, you can have unlimited profits. If the market goes up, you can have unlimited losses if you're wrong. Again, the beauty of an option. If I buy a put option, the most I can lose is this area here, what I paid for the option, the premium of the option. But if the market does go down, I still have the right to sell at the strike price, which was agreed up front, all the way up until the expiration of the option. So the main point I want to get across is that options give you asymmetric risk, an asymmetric risk profile. You have the right but not the obligation to exercise your option. Here's something else you can do with an option that's really super cool. You can sell options, not just buy options, but you can sell options. Think of yourself as being the insurance company. You have a view that the market is not going to go higher. You're willing to insure someone else who has risk to the market going higher. So if you have the view that this asset, let's say it's euro-dollar, is not going to go higher, you can sell a call option, get paid premium up front, just like an insurance company does. And if you're right and the market does not go higher, you get to keep that money. You earn that just like income. That's selling options, and that's something you cannot replicate in the spot trading market, in the regular FX or CFD market. Only options give you that power. So you can be the insurance company, get paid for taking that risk, and get paid for giving someone else the protection or giving somebody else the peace of mind that he cannot lose more. Now, you're taking risk here. You have unlimited loss potential, just like you do if you would go short the market and the market goes higher. Same risk, selling a call and selling a forward. What's the difference? If you're right, you're going to earn premium here or here. And even up here, you're still outperforming the underlying because you earned this premium. When you sold that option, you got paid for it. That's yours. That money is yours in exchange for accepting the risk of the market going higher. Selling a put option, very similar. Right? Sell to someone else the right to sell the asset to you. You think the market's going to stay around here? Sell a put option and get paid premium. There are other ways to use selling a put. It's also often called targeted buying. You can say, if the market goes down, I'm happy to buy. If you're comfortable with that risk, we can pay you up front. The option buyer is going to pay you up front for the right to sell to you at that known price. So Eurodollar today is trading at 118.50. If you said, if it drops to 117.50, I'm happy to buy. So you can sell a 117.50 put to AvaTrade and get paid for that option. If the market doesn't go anywhere, you keep that premium. If the market drops to 117, you get to buy at 117.50. And you kept your premium. So you still have that outperformance because you earned the premium. Here, anywhere it is, you earn that premium. I mentioned that we're trading European style options. That is the standard of the foreign exchange market. We also are trading what are often called vanilla options, European style options, vanilla options, as opposed to an exotic option or, for example, a binary option. We are not trading binary options at AvaTrade. And these options are what's known as over-the-counter. Just like everything else you're trading with Ava and other similar brokers, you're trading over-the-counter. Your counterparty is AvaTrade, which of course is an excellent, regulated, globally regulated, well-capitalized firm. So you might ask, what determines the value of an option? What's the right price for an option? How do I think about the valuation of an option? So I'm going to show you something that was developed for this purpose, for helping you to understand and really just see the value of an option. Developed by Sir Francis Galton, I think sometime in the 1800s. It's called a bean counter or a quincunx, which is a tough word to know. Let's say we've got this thing called a bean counter. At the bottom of our page, we've got these bins. At the top, we've got 1,000 beans. Okay, we got 1,000 beans up here. And these beans are going to drop through this lattice which is called the quincunx. If you ever played pachinko machines in Japan, a pachinko machine where every ball starts at the top, it hits a nail, it can go right and it can go left. Hits a nail, it can go right and it can go left. Hits the nail, it can go right and it can go left. And let's say it's got a 50% chance. Every nail it hits, it's got a 50-50 chance of bouncing right or bouncing left. Okay? 50% chance this way, 50% chance this way, 50%, 50%. We're going to drop all 1,000 balls down this lattice. This is what's going to happen every time. Okay? Every time we do this exercise of dropping 1,000 beans down the quincunx, we're going to get this distribution. Most of the beans are going to fall into the center. 50% chance going one way, 50% chance going the other way. Very few are going to make it to the extremes because to get out here, most of the time it has to bounce in the same direction, right? And the chance of that happening is very small. 50% of that times 50% of that times 50% of that. Very small chance of making it out to the end. What does that distribution look like? It looks like a normal distribution. So the market works the same way. Looking at the market today, all of the information about the market is already in the price. There's an equal number of people who think it's going higher as think it's going lower. We've reached an equilibrium. So from here, we can say, or in options theory, we talk about a random walk. It's random. Market can go up, market can go down. Every day it can go up or it can go down. And so options pricing theory looks at this normal distribution. And what do we know about normal distributions? We know that we can assign a probability to each of these bins. We can assign a probability to every point along this curve because we can measure how many beans fell in here. How many beans fell beyond this point? You'll see it more on the next page. So that's to give you a picture of how to think about options pricing. What if we had more nails? What if this quincunx was longer? That would be equivalent to having more time. Instead of the beans falling down for 5 days, they might fall down for 10 days. If you had more nails, if you had a taller quincunx, it's like having more time. If you have more time, more nails, a bigger chance of getting out to the extremes, and you get a wider distribution of prices. Okay? So more time, with more time, you have a better chance of reaching this bin here. And similarly, more time can also be thought of as more volatility. More events happening in the market, more action, again, you get a wider distribution. Now here we can see options can have any strike. I can have the right to buy at 117, or I can buy the right to buy at 118, 119, 120. Options are a contract between two parties, a buyer and a seller. We have complete flexibility to set the strike, to set the expiration date. In the case of AvaOptions, any time from 1 day to 1 year, and the right to buy and the right to sell. Let's see this, some of this in action. I'm going to superimpose on the right side the one distribution, which is the first one, or let's say this is a low volatility option, a low volatility market. The market's not moving around a lot. We're starting at a price of 50, and most of the assets are going to fall near 50. Over here, in the bottom one, we have a higher volatility. We have a wider distribution, just like we saw on the previous page. I'm superimposing on this an option with a strike of, well, it looks like it's about 58, even though I wrote 65. Right. We have an option to buy at 57. The strike is 57. Here's a strike of 57. What's the chance in this distribution, which is low volatility, what's the chance of getting an option payout? We have to multiply the chance, so the number of beans that are falling into this area times the payout. So take this value of an option times this area, and this value times this area, and this one times this one. The area here in blue are the beans that are falling beyond the strike, and that area basically represents the options value. If we have a wider distribution like this one, look how much more area we have in blue. What I'm just trying to show you is if we have a higher volatility, we have a higher value for the option, because this area in blue here is so much greater than the area in blue up here. Options pricing theory says that most of the beans, 68% of those observations are going to be within one standard deviation of the mean. Okay? It means that 68% of our observations, we expect, or we're 68% confident that the market's going to fall in this range. We're 95% confident it's going to fall in this range, and we are almost 100% confident that the market's going to fall within this range. I'm going to show you that in the trading platform. It'll be much more clear. So now you're an options expert. We've gone very quickly, so we're going to open it up to questions a little bit later. What are the determinants of the value of an option? First of all is the strike price relative to the current market. The closer we are to the market, the more expensive an option is. If I have the right to buy at the current price, it's more expensive than the right to buy far out of the money. Eurodollar is trading at 118.50. That's cheaper. Sorry, that's more expensive than the right to buy at 120, because the probability of getting to 120 is obviously lower. The market is already here at 118.50. The probability of getting to 120, 125 is much smaller, so that option is less, as we showed in the previous slide. Time, similarly, more time is more expensive. When you buy insurance on your car, insurance for a month is much less than insurance for a year, because you have more chance of having an accident in 1 year than you do in 1 month. Very simple. Doesn't matter how good a driver you are, because it's not only up to you. More time is more expensive. And volatility. As we showed, the more volatile an asset, which is similar to time, the more expensive an option will be. Insurance for a good driver is cheaper than insurance for a poor driver. Insurance for me is much cheaper than insurance for my 18-year-old son. Right? So the strike, or where is the right to buy, is one determinant. Time is another, and volatility is the third. These are what drive the pricing of an option. Now, I've shown you a lot of numbers and pictures. The best way to see this is going to be in the trading platform itself. And we're gonna get to that in the next few slides. So why use options? And I hope we've answered some of these questions. Number one, they let you fully express your market view. You don't have to simply say, I think it's going up or I think it's going down. You can say, I think it's going up, but I'm not sure, and I want some protection. You can use options to protect risk. If you're a business, if you're an importer or exporter, and you have inherent risk in your business to foreign exchange rates, for example. Options let you balance your risk and reward. You can sell an option and earn some premium. You're getting paid for that in exchange for taking risk. You can take more risk or you can take less risk. Whatever risk you're taking, you're going to get paid for according to the market price, which is driven by the options theory, by supply and demand, etc. With options, if you're buying options, you can have unlimited gains with limited risk, right? You buy an option, you pay a specific amount up front. The most you can lose is what you paid for the option. You get to control how much exposure you take. What's your maximum loss? And you can trade with less stress. If you're bullish, if you think that Eurodollar is going higher, if you simply buy Eurodollar FX, any moment that trade can drop and you could be losing money and you can get knocked out of the trade because you can hit your stop loss or you hit a margin call. With options, when you buy an option, you pay the money up front, you can walk away, come back in a week, see where the market ended up. If you were right, you have big profits. If you're wrong, you only lose what you paid for the option. You can trade with less stress, which is a great thing to have. And you have new ways of earning income by selling options, the examples I gave. Lastly, I will say that options traders have more fun. Why with AvaOptions? Number one, this is the best platform for trading options. It's amazing for the underlying instruments like FX and indices and gold and others. You're trading, remember, vanilla calls and puts, not binary options. We have more than a dozen option strategies, not just buying or selling a call or a put. We have call spreads and put spreads and risk reversals and other things that you're going to learn about. We have integrated Autochartist signals, which is a great tool, not easily found, beautifully integrated into our platform. In the EU, if you are an EU retail trader, leverage is limited by regulation to, I believe it's 30 to 1. If you trade with options, you can use 100 to 1 leverage. So options give you more opportunity. Sorry, it's 33 to 1. So options give you more leverage, which is an excellent feature. And we offer risk management tools built into the trading platform. We have clear and unique interactive trading screens, which are entirely chart-based. And we have social trading, integrated chat, trade FX and CFDs and options with limit and stop, entry and close. You can have multiple partial closing limit orders. So if you buy 100,000 Eurodollar, you can leave orders to sell 50,000 at one price and 50,000 at another price. You don't have to leave an order on the entire amount. We have efficient margining. Margin is based on what's called SPAN, which is a scenario-based or VAR-based risk margining system. We essentially look at all of your positions. We calculate what kind of risk you have in your portfolio, and we calculate the margin this way. You can find more information about that in the trading conditions page and the financial instruments page of the AvaTrade website. The app is also, by the way, translated into all of these languages, even if I can't speak them. So let's look at the platform itself. This is what the initial page of the trading platform looks like. I'm using the mobile app for all of these examples because that is our most user-friendly interface. It's really just a really sweet interface, and I'm sure you're going to like it. Here you just see a bunch of numbers. Like many trading platforms, you know that you can trade euro-dollar and sterling and dollar-yen, etc. Bid and ask on the left, high-low close on the right. But that right side panel, I can swipe that top panel to the left, and I can see more information such as implied volatility. Implied volatility is the measure. It's the one number that we can use to describe the pricing of the option. Higher volatility is more expensive, lower volatility is cheaper. In this example, in this screenshot, blue is showing us where options are today when quoted by implied volatility. Blue is today, green is where they were a week ago, and red is where they were a month ago. So at the time of this screenshot, options were on the Australian dollar were much cheaper than they were a week earlier. Let's first look at trading spot, just trading FX, looking at trading euro-dollar in the app. Before we even look at an option, this is what it looks like to trade euro-dollar in the app. I clicked on the buy of that previous page, and I get a chart on the left, which looks familiar to all of you. The chart is showing the last 1 hour of history. The size of each bar is a 3-minute bar. That's automatic. You can change how much history you see. In purple, I've added a moving average. On the right side, we have the profit and loss diagram, and this is really what sets our platform apart, aside from being shown in landscape mode. We're showing you how much money you're going to make if the market goes higher if you execute this trade, and how much you stand to lose if the market goes lower. And all of this is interactive. So you can see, you can visualize immediately, based on a size here of 400,000. I'm just trading the spot FX itself. If I buy at 112.86 and the market goes higher, I'm going to make money. If it goes down, I'm going to lose money. And you can see exactly how much in your account currency. We can click this limit button on the side. Sorry, I have to draw with my mouse. If you click that limit button, it opens up the limit panel. The limit panel gives you a really nice visual interface where you can just touch that limit panel and put in a take profit and a stop loss. I put a take profit here at 113, and you can see that if I buy at the current market 112.85, the market goes up and it reaches my take profit, I'm going to earn $600. This is a dollar account. You can slide this handle up and down, or you can long press and type in your own level. I've also put in a stop loss at 112.75. If the market hits my stop loss, I'm going to lose $400. You can see the numbers. You can see how it works. Above my take profit, I'm out of the trade, and therefore the profit and loss diagram is gray. Below my stop loss, I'm out of the market, so my profit and loss diagram is gray. So we've got this great visual cue to risk. You can see how much you stand to make, how much you stand to lose. Now let's look at an option. Everybody says options are complicated. I promise you, they're not that complicated. Everybody says options are risky. It all depends on how you use them. It's all about leverage. If you're buying an option, it's not risky. You can only lose what you paid for the option. It's far less risky than trading the underlying asset. Here we have a call option. You can see that strategy button says call option. The size is 100,000. I'm buying a call. Here's a new element, the expiration date. It's a 7-day option. So I have the right, I'm looking at buying, the right to buy euro-dollar in 1 week. And here's my strike. 113.40 is what I've set for the strike. This green button that says call is a slider. It's a handle. You can move it up and down. And as you move it up and down, the price of the option will update and you get to see prices for the option at any strike, or if you click this expiration date button, you can change your expiration date and look at options anywhere from 1 day to 1 year. So the payout diagram now shows you if the market goes higher above the strike, I can have unlimited profits, right? All of this green area, you can see it's going incrementally higher. And if the market goes down, if I'm wrong, if I bought this call option and the market goes down, all I can lose is what I paid for the option. I'm paying 22.5 pips, 0.00225 times 100,000, that's $225. That's the most that I can lose. So now you've got a picture. And if you think about it, if you look at this picture and you offset the green and the red, they're balanced, right? The area looks balanced. Now we've got one really important new element on this screen, and that is this arc in the middle, which is called the confidence band. This white arc here, that white arc there, I don't know how to erase what I just wrote. Eraser, yes. Just get rid of these other things. That white arc is the confidence interval. In white, we're showing where the market may go, or where the market is expecting as a probable range for 1 week. This white arc is showing plus and minus 2 standard deviations of movement. This white dot up here is 2 standard deviations higher. And then down below, it's actually off the screen, would be 2 standard deviations lower. In shading here, you can see a lighter gray. That's 1 standard deviation of movement. And here on the outside, you can kind of make out 3 standard deviations of movement. So we're framing the risk of the trade. We're saying we've got a 68% probability of being within that white band. So we're framing the risk, and as you change the expiration date, the entire chart will update to still frame the risk in terms of plus and minus 2 standard deviations, and you can slide it all around. We can also put in a take profit. So here's a take profit on the option. I'm going to buy this option. Now I'm looking at a different option. This option is also for 1 week, but now my strike is 111 when the market was trading at 111. I'm buying this option for 57 pips here, and I'm putting in a take profit at 150 pips. So if I buy at 57 pips, the market goes to 150 pips, I'm going to make this amount of money, $930 of profit. Now we have here another line, which is this, the red and the green is showing you your profit and loss at expiration. The yellow line over it is showing you your profit and loss as of the horizon date. So right now, you're buying this option today. The market's trading right around here. Let me change that color, sorry. Ink color. The market's trading right here in the middle. So today, you only suffer a bid-ask spread. If the market goes up, you're going to start to make money immediately. You don't have to wait for expiration. If the market goes down, you're going to slowly start to lose money. Okay? It's not 1 for 1 because it's at the money. You have time value. So the option is going to move up and down according to what's called its delta. It'll start to move up and down with the market. At expiration, your profit and loss is going to be either in the red or in the green. But today we're on this yellow line. The yellow line is the horizon line, and that's today. And we can change that horizon line by clicking the horizon button, this thing right up here. I click here and I can slide it out, and I'm hoping to show that to you in a few minutes on the phone, from my phone itself. Here's the picture of selling a call option, right? I've moved my button to the left. I've clicked on sell. Now we're looking at selling this option, which means I have unlimited loss potential. If the market goes higher, I've sold an option, I can lose an unlimited amount. If the market goes down, I've sold a call, so if the market goes down, I get to keep my premium. So that's earning income, right? Sell a call, earn income, get paid for taking risk. I'm just going to see if anybody's typed in a question. I've got to figure out how to open this thing. Here we go. Okay, now I can see if you have questions. Thank you very much. I see your screens. Okay, thank you, everybody. Sorry again about the slow start that we had. Okay, now we're going to look at one other thing with the app, which is strategies. If you click that button right here, this call button, it says the word strategy. It's a little bit dark on the screen right now. If you click on the strategy button, you get a menu. This menu lets you choose the type of strategy you want to trade. You can trade spot, which is just trading the FX or the CFD, just trading the asset just like you would with MT4 or MT5. Or you can trade a call, you can trade a put, you can trade a straddle, which is an options strategy where you're buying both a call and a put. You can trade a butterfly, strangle, straddles, condors, and you can click on one of these buttons and get an explanation. If you click on one of these buttons, I've now clicked on call spread. I'm buying a call spread, it gives me an explanation. What is a call spread? Buying a call spread means I'm buying one call and I'm selling another call. I'm going to get two buttons. I'm going to get one button in green and one in red. Buying one, selling one, it's moderately bullish. The risk is limited, the reward is limited, volatility has a small impact on you. Ideas set the strikes according to your risk appetite. If you think this idea looks interesting, click the button, try it, and it will populate the screen with a call spread. Now here's a nice picture of a call spread. Okay, here's a call spread. I've now got, as I said, two strikes. I've got, let me put on my laser pointer there. I've got two strikes. I've got the strike that I'm going to buy, and I have the strike that I'm going to sell. I still have this 2 standard deviations, which frames the risk for me. This is now a 33-day option, 1 month, right? So it's showing me 1 month of history. It's showing me where we might be. What's a decent range to expect for the market 1 month from now? And the red and the green shows you your risk and reward profile. The yellow line is showing us today how much money we might make or lose if the market goes up and down, assuming constant implied volatility for someone who, for those of you who ask. And you can see again the profit and loss numbers. You can click buy, you can click sell. And by the way, because you're doing a strategy, you're buying one leg and selling another leg, we improve the pricing of one leg. We reduce the bid-ask spread. So you've got a better trade, a better way to put on your risk. It's better than trading one leg and then another leg and trading them independently. You trade them together as a package, we give you improved pricing, and it says we've improved the pricing by 1.6 pips, 0.00016. I don't know of any other options trading platforms out there that can do that for you. It's a very, very handy, powerful, and clear. So now I'm going to click that buy button. I get the trade confirmation screen ready to execute. It tells me what I'm doing. I'm selling this call and buying this call. It's going to cost me $2,200. I have 118,000 of margin available. This trade is going to cost me a little bit of margin, $537. It's got the bid-ask spread. If you like it, you click execute. And you can click up here, this sharing icon. With this sharing icon, if you click on that, you'll get a link will pop up using the standard iPhone or Android sharing menu. And you can share it with your friends or share it with your followers or share it on a blog. You'll get a unique link with these details so that anybody else who receives your link and clicks on it can copy it. Nicholas is asking if we offer options on CFDs. Nicholas, so far we offer options on 42 currency pairs, gold and silver. We've just added equity indices, so we have some CFDs. We don't yet have options on CFDs, but it's in the works. We're working on that, and we hope to have that in the fourth quarter. Autochartist, let me just, this is nothing to do with options really, but a great feature of the platform. We've embedded and really integrated nicely Autochartist trading signals. For those of you who don't know, Autochartist offers automated pattern recognition. So it looks at the market identifies trends, identifies signals, and gives you trade ideas. So in this case, in the case of, let's say, gold, here we're looking at trading ideas on gold. You think that this looks like an interesting idea. It's a 1 hour, it's a chart that was based on a 1 hour candle. The pattern name is called a flag. This is when it was identified. These are some metrics of the quality and the trend line and the clarity, and if it's a breakout. It looks interesting, click it. You'll get a little more information about that trade idea. So it's showing you where the market's been using that 1 hour candle and where we should be headed according to the pattern recognition. So at the time this trade was identified, the chart ends and then it moves to white to show you what's happened since this trade was identified. Okay, let's see, where are we? Okay. Somebody's asking if we're planning to offer American style options. The answer is no. And is it possible to get a copy of the presentation slides? The answer is yes. We're going to reach out to you all after this presentation. Thank you, Richard. So I click on that. It looks interesting. I click trade. It's recommending a stop loss at 17.24. It comes straight into the trading platform with a stop loss set up, ready to trade. And down next to the symbol, next to the product, next to gold, we have 9 circled, and the trend line with an Autochartist symbol in green. That means that the most recent signal is bullish and that there are 9 ideas that you can look at. If you click that 9, it takes you right back to that first screen with the 9 ideas. Risk management tools. This platform has integrated risk management tools. It shows us, first of all, information about our account. What's the account value? This little green bar is showing us that we're using about 34% of our available margin. So you can see that on any screen. It's always available to you. You can keep an eye on it. So the value of the account is $180,000. The cash balance is $65,000. The options that I own are worth $72,000. I have unrealized spot P&L of $42,000. Required margin, margin utilization, available margin, all here. And these bar charts are super. It's showing us our exposure according to the currency, not the currency pair. So if I'm long euro dollar, it's going to break it down to say that I'm long euro and short dollar. If I'm long euro Swiss, I'm long euros and short Swiss. And it's going to aggregate the risk in each of those currencies and convert it to your account currency and show you your risk this way. If I were to click here on total delta by currency pairs, it'll show it to me by currency pair instead of by currency. Somebody's asking me about desktop. We have a desktop platform. It's different than this one. It's more of a professional or money manager tool. And we're now developing our web trader with this same look and feel. The web trader should be available in the next couple of months. And we'll have integration over time of all of this stuff there as well. And you can log into your account and trade it in mobile, in the web trader, or on the desktop. It's all the same account. If I click on the risk manager, if I click this button down here, risk manager, I can see my risk by currency pair. For example, in cable, which is the pound against the dollar, is called cable. Some of you might be old enough to know what that is, like me. I have 9 positions in cable. My total delta, my total exposure is 1.38 million cable. My cash position is 300,000. That means that I'm long 300,000 of foreign exchange itself. And through options, I'm long exposure to another million. So my total exposure is 1.3 million. My exposure to implied volatility is $1,165. So if the market gets more volatile, I'm going to make money because I own options. And it's showing me my unrealized P&L as well. Just want to be cognizant of the time. Okay. We have open positions. Here you can see all of our open positions. What's my position in the FTSE? What's my position in cable? So here I'm long the pound, 100,000, and I have a stop. In blue, it's pending. Makes sense. It's cool. It's pending. We have an order, and you can see that it's linked with this diamond. So I'm long the pound against the dollar, and I have a stop loss at 120.75. And here I bought a call option. Strike is 124.50. And on the right side, we have Where was I, Phil, that bought this for 70 pips, 0.007. Now it's worth 120 pips. I've got $5,000 of profit. I can swipe this way and get lots more information about our positions. We also have the desktop platform that I mentioned, fully customizable. You can move your windows around and mix and match and do different things with it. It's a lot of numbers. It's more number oriented as opposed to chart oriented. But you also have risk management tools. You can execute portfolios. It's good for money managers who can execute trades for multiple accounts at once. And you're using the same account whether you're using the desktop or the mobile. And as I mentioned, we have a great web trader in the works that's going to be nearly the same as the mobile app, but of course it's going to take advantage of the features of a desktop, all the extra space that you have. So that's the end of that slideshow. We actually really don't have a lot of time left, and I don't want to keep you longer. I know we got a late start, and I'm very sorry for that. We're definitely going to do this again, possibly in a week, so we can go over it again, and perhaps we'll schedule a follow-up, maybe a more advanced course. But for now, why don't I open it up to some questions? And I really do encourage you to install the app. Somebody's asking about commissions. There are no commissions. These are over-the-counter options, just like trading foreign exchange or CFDs with AvaTrade. You only are paying the bid-ask spread, and our prices are very super competitive. So it's a no commission structure, tight spreads. The spreads on trading foreign exchange are the same as they are basically in MetaTrader from AvaTrade or on AvaTrade Go. It's the same firm, the same pricing. So you're getting a spread of like 0.8, or maybe 1 pip in Eurodollar, and whatever it is across the board. It's the same trading. No commissions. Swaps also, overnight interest rates. So 2 things I need to point out about swaps. Same swaps as you have in the other platforms. However, options don't have swaps. When you buy an option, you don't pay overnight interest. You pay for the option. You don't have to carry any position overnight. So there's no swaps, no overnight interest. And we offer a structure called synthetic forward. Where's the picture? There we go. Synthetic forward. The synthetic forward is a strategy where you're buying a call and selling a put. It has exposure identical to trading spot. But instead of trading regular FX, you're trading it in the future.